The U.S. economy, even after years of turbulence, remains one of the most watched economies in the world. Right now, 2025 is shaping up as a crossroad. Some signs point to stabilization, while others raise questions about underlying weaknesses. In this video, we'll walk through the latest developments: inflation, interest rates, employment, consumer behavior, and what it all means for investors, workers, and the global markets. Recent inflation and price trends. Inflation in the United States has come down from its peak, but prices are still a little higher than what many households and businesses expect. According to the latest report from the central bank, price hikes have eased compared to mid-2022, yet core inflation, which excludes volatile food and energy, remains modestly elevated. At the same time, higher costs on imports and tariffs have added pressure to some goods and services. This has muted some of the gains that Americans might have expected from lower inflation. Interest rates and policy moves by the central bank. The benchmark interest rate in the U.S. saw a shift in 2025. After years of high rates to fight inflation, the Federal Reserve, the Fed, has started reducing its key rate. The latest decision cut the rate for the second time this year, bringing borrowing costs down slightly. This shift signals that the Fed believes inflation is under better control, but also reflects growing caution as the labor market and economic growth show signs of cooling. Growth trends and economic output. Despite some recovery signs, the U.S. economy is not booming. Growth forecasts for 2025 have been revised downward. Many analysts expect a modest growth rate rather than a robust expansion. Part of this cooling is driven by weak business investment, rising tariffs, and reduced consumer spending. Combined with lingering inflation, these factors make the near-term economic outlook more cautious than many hoped for. Labor market and consumer sentiment realities. On paper, the job market has shown resilience, employment remains relatively solid, and many service sector jobs are still being created. However, wages are not rising as fast as prices, and for many households, inflation-adjusted income feels flat or even shrinking. This squeezes consumer spending power, which in turn slows overall demand in the economy. What it means for investors, businesses, and consumers. For investors, lower interest rates may provide some relief. Borrowing becomes cheaper, and corporate profits might get a boost if demand recovers. But volatility remains, especially if inflation surprises or global uncertainty rises. For businesses, tight margins and cautious consumer spending could translate into slower growth, more selective hiring, or delayed investments. Those heavily reliant on imports or global supply chains may feel the pinch more. For ordinary people, it's a mixed bag. Loan and mortgage rates may ease, but everyday costs remain elevated. Saving might still be worthwhile, but spending power and job security could remain uncertain in some sectors. Final thoughts: a mixed economic picture in 2025. The U.S. economy in 2025 is balancing on a tightrope. On one side, inflation is easing and interest rates are coming down, signs that stability might be returning. On the other side, growth is modest, consumer pressure is real, and many households continue to feel cost of living strain. It's unlikely we're heading toward a dramatic collapse. Instead, the most probable outcome is a soft landing, slow growth, manageable inflation, and a cautious recovery. But whether things improve meaningfully depends on future policy, global economic conditions, and consumer resilience. If you enjoyed this update, make sure to subscribe to AutoFin Path. In the next video, we'll explore concrete scenarios. What happens if inflation spikes again, or if the Fed reverses course? Until then, keep watching, stay informed, and let me know in the comments, do you think 2026 will bring recovery or more slowdown?